Hey guys, it's Max. How's everybody doing? I discovered a new fund out there, covered call fund or a short put fund. Regular viewers of the channel understand that a fund that sells puts, cash secured puts, functionally the same thing as a fund that sells covered calls. Well, anyway, uh, be that as it may, there's a new one out, and I thought it'd be fun to go through the prospectus together and maybe do a back test or two. And let's because this is an interesting strategy. It's a strategy. They are selling puts and it's daily options, but it's doing it in a manner that no one else has done it this way before. It's totally different than the way Defiance did it. Defiance, when they came out with Triple QI, invented the daily put right fund, and it's that thing's a banger. But since then, technology's moved on, and you have and Defiance has better funds out there, in my opinion. But and there's better income type funds, but that was the one that kind of kicked off. Well, this one just came out a few days ago. I checked it out on FinViz, to see how bad the recent pullback hurt it. And it looks like it went from 2560 to 2505 in that big pullback the other day. It's only been out about 5 or 10 days. Anyway. It hasn't paid a dividend yet. So let's talk about the strategy. Okay, we've already said it's a daily put right ETF. So I'm trying to go through this fast. I scanned it earlier. Here's something really good. The management fee is only 79 basis points. That's good because a lot of these funds that do these types of strategies charge a full 100 basis points or a full percent. So that's good, right? I mean, just comparatively. I would say that's a little bit less than average. Let's just say it that way. All right. So the fund seeks to provide current income while providing capital appreciation. So it's going to pay a monthly dividend. Principal investment strategies. The fund's an actively managed ETF that it seeks to provide current income while maintaining capital appreciation. The fund will invest 80% of its assets in equity securities and financial instruments that give economic exposure to equity securities through a daily put right option strategy. And then it talks about the advisor and the sub-advisor. I haven't heard of them, but I'm sure they're awesome. I mean, it's no one no one whose name I recognize, but that means nothing, as you guys know. Hey, Jackson, do you want to say hi? Come here, Jackson. Oh, he doesn't want to say hi. He wants more food. Jackson, what are we going to do with you? All right, so investment growth potential, so capital appreciation. So they kind of further describe what they do, and this is kind of an interesting part as well. They split their fund into three parts. So the capital appreciation part, the fund invests 50% of its assets in stocks. All right. The fund, okay, that's 50%, but then the fund invests 25% to get current income. Now that's this option selling program. We're going to talk about it in a second. It's the daily put right program. But anyway, they use 25% of the capital for that. And then the last 25%, the fund puts into T-bills. So this should be, this is an interesting idea, and no one else has done this before. But here's the real interesting thing. It says down here, the fund implements an option strategy by investing 25% of its net assets either in an equity-linked note that provide leverage 3.75 to X exposure to daily put contracts, through ELNs. That's called an equity-linked note, or it says or directly through listed contracts. But so the fund invests 25% of the money in this put right strategy, but they lever it up 3.7 times. That tells me 3.75 times 25 is basically 100. So they have basically 100% exposure anyway They may not pay for it. That's what the leverage is, but they have 100% exposure to this daily put right fund, which is awesome because it's a solid strategy that they're doing. And then they put 50% of the assets in stocks and 25% in T-bills. I mean, I like that part so far. It's only been out a few days. Let's see what else we can find out about it. I can link to, of course, I'll link to this. I'm seeing if there's anything else. This is the interesting part to me, and it's kind of in the weeds, but the fund is designed to provide monthly distribution payments. That's what I'm interested in retirement, while providing capital appreciation. I'm also interested in that. The following chart represents the fund's portfolio related investment function of each component, approximate weightings within the portfolio. The fund's an actively managed fund. Accordingly, the sub-advisor is subject to supervision of the advisor and has discretion to select the fund's investments and implement the fund's investment strategies. Okay, so the option strategies. I know we've gone over this, but I just want to reiterate some stuff. So this is 25% of the assets. And then the details, it says the fund will have exposure to daily put contracts that cover 100% of the fund's assets through a portfolio of leveraged ELNs or a combination of leveraged ELNs and daily put contracts sold directly by the fund. That they're going to sell these puts, and that's how they're going to pay you the yield. Then it says intended investment function. This provides the fund with recurring monthly income. The option strategy generates income in form of premiums received while subjecting the fund to the potential for downside exposure from losses experienced by the SPX. The exchange-linked notes provide leverage 3.75 to 1 exposure to sold daily put contracts, and when combined with any daily put contracts sold directly by the fund, if any, provide an income received. Well, anyway, okay. This is kind of an elaborate way they kind of lever up their puts, and we're going to look at some other stuff too. But in any event, the equity portfolio is 50% of the fund. So then with 50% of the fund, they just buy stocks. All right. And then 25% of the fund, they buy T-bills. Okay. Pay monthly. The rest of it's kind of boilerplate. It says, while the option strategy seeks to minimize risk associated with the written put option contracts, the fund's daily sold put contracts subject the fund to risk of loss. Yes, no shit, Sherlock. A put subjects you to a lot of risk. We're getting ready to look at that in a second. Anyway, but let's just get right into all that. Okay, so let's look at the trade here. They do this every day. This is option strat. This is the SPX. See right here, I can drag the put, the contract I want to sell. As I drag the put to the right, it goes, that's at the money right there. As I drag it to the left, you can see the strikes, it's further out of the money. These guys sell this put. They sell the put that's a 95% chance of winning. It's the 5 delta. They sell this put every day. So look at this. Look what this does. You can sell this thing every day, which they do. It's bid at 220, asked at 225. So you can get $220 for this, which is awesome. There it is. That's your credit. And this is a trade you're going to win 98% of the time. Okay? But you're on the hook to buy at 54.10 if it drops underneath that. So in a big drop, you could have a big loss. Now, it's not going to drop underneath that very freaking often, but when it does, it's not going to be pretty. But that's the strategy this thing's doing. They're going to write a 5 delta put. 5 delta means it approximately expires worthless 95% of the time. According to option strat, it's more like even 98. Anyway, But this is what they call picking up pennies in front of a steamroller, because you're making $220 on $541,000 risk. Are you kidding me? But these strategies actually backtest really well. Believe it or not, this strategy has a pretty decent edge. Anyway, so let's look a little bit further. But this is a way that no other fund is doing calls like this. I made a duplicate tab just like I always do. I made a duplicate tab, and I want to show you kind of visually, and I was kind of doing this a second ago. This is what the new fund is doing, selling the far out of the money. The green area is the profit, the red area is the risk. You can just visually see profit to risk, but you can also see the chance of profit right there. It's a 99% chance of profit, but look how much risk you do have, in a down move. Now, I mean, that granted, so if the market moves down 5%, in this example, the fund would lose $9,000. Okay, and it only made 200. Now it makes 200 every day, and it makes up 98% of the days. But when it has a bad day, if the market's ever down 10% or something, I mean, anyway, this is picking up pennies in front of a steamroller. Now, what I consider it's a more sane way to do puts is to sell them closer to the money or even in the money. So watch as I drag the strikes across. Watch how the green area gets bigger. The chance of profit, you can see, is decreasing. We're only at 85% chance of profit. The green area gets bigger, and the red area gets smaller. And now I'm going to show you right here where the dotted line is at the money. When we get the option right to at the money, that right there, the option is at the money, 55.80. That's pretty much where the market closed. We can look at the delta. It's a delta 48. Usually the options delta is around 50 at the money, meaning it's a 50-50 shot. It's at the money. You can see here when you sell this option, you're capped out from the get-go. You don't have any chance of profit, but you have the maximum amount of credit. If you're going to be capped out, at least you have a $4,600 credit. The other way where you sell far out of the money, yeah, you're still capped out and you only get a $200 credit. So the other school of thought says, well, heck, I'm just going to sell an at the money option. And then the way Jay does it, what even backtest best, the best way to do it according to the backtest is to sell an option that's in the money. It's about a 60 delta. And that's what Jay does, and that's what Defiance does. And what that does for you is that gives you a daily setup where you get a credit. You get a credit right there. I mean, how much credit do you get? $7,600 on. I mean, in this example, you win about 65% of the time. But if you have a day where the market runs, down here is the market's price. If the S&P's up 50 handles, opens around 5,600 and closes around 5,650, your equity can go up. You can make money. The ETF or the strategy can make extra money as the market goes up. You can monetize the market moving up. Okay. If the market moves down, you bear pretty much the full weight of it after the buffer kicks in. If you look at this, all of these, this one has about a 0.6% buffer. But after that 0.6% buffer kicks in, then you bear the full brunt of a down move. So anyway, that's the way Defiance does it. That's one school of thought. Here's the other school of thought. Now we can also look at it this way. We can backtest. The out of the money way doing it. We'll sell one put right there. That's a 5 delta every day. We'll run the back test. This should be easy. We'll just do the back test for the last year to make this easy. We'll just look over the past 12 months. There was one day that really killed this strategy, and it was December 18th. It was the day the VIX blew up and went to Remember that there was one day and the market made a really sharp down move, and the strategy was doing great, picking up pennies in front of a steamroller, making a little bit of money every day, $200, $100 every day, $100, $100, $100, $100, an occasional loss. But then you get this one giant loss, they give back the whole year's profit. But well, anyway, by the end of the year, they're fine. But that's just kind of the way this strategy works. Now, look, you can compare it to buy and hold. You would have done better just buying and holding. Buying and holding was up 7,400. The strategy was only up 2,500. However, buy and hold had a max drawdown of 10%. The strategy was only down max 5%. The strategy is less volatile than buy and hold. The other advantage the strategy has over buy and hold is buy and hold doesn't earn cash. When you're selling options right here, see this average premium? This is every day. You earn $100 a day during this on average. You net $100. You gross $100 a day, $107 a day. During the strategy over the course of this year, you netted $24 on average per day. That's not bad. However, look, it's on $120,000 used capital. And it's really more than that because, I don't know how they figured the used capital. I need to look into that. But in any event, it should be more than that because the S&P is a $560,000 contract. They're giving you credit for leverage. They're giving you 4-to-1 leverage, but it's weird it does that because the fund's taking advantage of that kind of leverage too. Well, anyway, but you could see the wins and loss patterns, picking up pennies in front of steamroller, little wins and then little wins and occasional big loss. All right, well, that's fine. So here's the other way to do it. Here's for the last year, if a guy would have done selling in the money. And the last year hasn't done great. The past 12 months has not been great for this strategy. Just selling the in the money option. This strategy was actually down. But it's down. But the only reason you would even do a strategy like triple QY is if you needed an income. It does pay a good income. Look at this. It made $2,400 a day gross. Now, I mean, you didn't net any because the market pulled back and you had a bunch of losing trades in there. But yeah, it's been a rough year, and especially lately. Look at this. Lately, and that's because the market's down every day. So, been a rough time for that strategy. But if you look at lately let's just go back to the last year on the out of the money strategy. They did give back a lot of the profit in that one trade, but the past time, the pullback hasn't been bad. It was just that December, I think it was December 10th. It was a gigantic weekend overnight gap down. But you can see right here, it's been business as usual. The moves so far haven't been far enough to make the option lose money. Jackson, knock it off, please. All right, he's getting impatient. All right, well, that's pretty much all I wanted to talk about. I just wanted to show those back tests and talk about this fund. It's from Innovator. The funny thing is, Innovator is known for the buffer funds. And I found this fund last night when I was doing that other thing on the buffer funds, and I found they had this new volatility based fund. And I'm such a sucker for these funds that are short volatility or long volatility, but these volatility based funds. And this is an interesting idea, and they incorporate leverage. And from what I understand, I've never worked for a bank or a hedge fund, but I think hedge funds do stuff like this too. They have option selling programs and they lever them up, but then they're doing other stuff at the same time. And I think maybe it's a little dangerous to lever them up or whatever, but they also have 25% of the portfolio on T-bills, which probably takes some volatility out of it. We'll just have to see how they do. We'll just have to see how they do. Obviously, we'll just keep an eye on these guys. And by the looks of it, here's, I guess, one other thing we could talk about. It doesn't look like it's going to be a huge payer. Selling this option, we could see how much this would have paid. Like I always say, the only reason we do this is for the money, for the income. It paid 107 a day. Well, but we kept 25 a day. But anyway, but 107 a day comes to total premium 11,000. So it's 11,000 premium on 120,000. So it's right at about 10% over the past year. And of course, that's the advantage to doing it this way. That selling the 60 Delta, the premium's 250,000 on $183,000 capital, more than 100%. And that capital, that's some leverage in there, but even unleveraged, this comes out to like 50%. Yeah, it does, because unleveraged, it comes out to 50%. So, that's the reason people sell the in the money options. And additionally, when you have an up market, the in the money options also have a little bonus because they can benefit from the market moving up. It just hasn't been moving up lately, and that's why this strategy is just getting murdered. It can only do what the market can do. We can put it on a period. We can do this strategy, the Defiance strategy, over a period when the market's moving up, and it'll, and it usually does all right. So let me try to do it in a bullish time period and see how it does. Yeah, and this is more indicative. This is selling the slightly in the money, the 60 Delta put. This is a great strategy. And look at this one, return on used capital. It beat buy and hold over this time period. So, not to mention buy and hold. What does buy and hold not do? Buy and hold doesn't pay you an income. What does selling options do? Pay you an income. What did this pay you? Well, you gross $2,200 a day. Now, granted, this cost $500,000 to do this trade, but you gross $2,200 a day, and you netted 500 of that. Total premium you brought in was 384,000. And like I said, it cost 500,000 to play in this arena, but that's what, 60% or something. That's the reason that one's the attractive one to sell. It doesn't mean it always works out, but you can see in a bull market because it does monetize the market going up. It makes extra because it sells the slightly in the money put, which is like an out of the money call, because they can monetize a little bit of the up movement in the stock, and you can see you get a market that moves up, you get a situation like this, But anyway, so I prefer selling the options like this, but there is nothing wrong with doing it like this also. Let's do the same time period that I just did for that other one. It was called post-pandemic surge. So it was after the pandemic, post-pandemic surge. Let's do the out of the money option strategy and see how it did over the same time period. It probably did great. Look at that. You want to talk about, it had one loss here during May of the pandemic. There was a big loss one day. Then you had a big loss in May again of 21. Other than that, it's solid wins all the way through 21. But the market was just a straight up face ripping rally. Now, if you did it this way, you underperformed. It's not, you're leaving money on the table. But like I always say, you're doing it for income, not for growth. And so let's see how the income did. You made 137, grossed 137 a day, netted 109 after it was all said and done, after you paid for that gigantic loser. It's $23,000. Was this a year? This was just half a year. So 23,000 for half a year. So call it 45 for a year on 94. That's about a 50% rate. Is that right? Well, no. Okay. It's 43, but it really cost $500,000 to put this trade on. It's like 10%. The far out of the money options, I think, are going to pay 8 to 10%, but they're going to lever them 4 times too. So maybe they'll unlevered. They appear to pay about 8 to 10%. So we'll see. We'll see. Okay, so I guess that's basically all I have. I just wanted to show this. The ticker is SPUT. The ticker's SPUT, I guess. Yeah, no, that's all I had to show. I was just looking to see if there's anything else we had to show. Sorry to go on a tangent, but I like to explain the difference, why different strategies work. The in the money option selling strategy, like Defiance does, the 60 delta works better in some markets, but the out of the money works really well in some markets too. I mean, all you need to anything. I guess what I'm trying to say is anything works in the nut market because this was just a face ripping up market. Let's try to pick the worst market for this. That's like the last time Trump was in office, I bet was really bad for this strategy, these far out of the money puts. I mean, I may be wrong, but when the energy sector collapsed and the trade war roller coaster, I want to do both of those. I wish they did one that encompassed all the way from I wish it said Trump's last time in office. I guess we could do it like this. 2016, 2021, 2020. I mean, 2020. I mean, it's not exactly as close enough. But yeah, this would be a pretty rough time. Look, you gave back all your money during the trade war roller coaster. A couple of times here, look, you just got beat up in 2018, late 2019. Volpocalypse didn't really, surprisingly, Volpocalypse didn't get it that bad. But the pullback in November and December, which is similar to kind of pullback we're having now. So that was not a good time for selling options. You can see option selling strategy. No option selling strategy did great. Some do better than others, but this one didn't do great. You can see just the equity curve kind of went sideways, but then as the market went straight back into face ripping 45-degree up mode, and even though it went down, it recovered really quick. You can see, for that type of market, this strategy works great. But for this type of market it's not so great. There's no one strategy that works for every kind of market, or else we would all just use that, obviously. Of course, then it wouldn't work anymore. That's the way it goes. All right, guys. Well, I just wanted to get on here and share that stuff with you. All right. I hope you have a good day, and I will share the link to the prospectus, and you guys can read it and let me know what you find out. All right. See ya.